Hey everyone, I'm Anita Sharma. Welcome to Market Call on BNN Bloomberg. David Burrows is our special guest today. He's the president and chief investment strategist at Barometer Capital Management. We're taking your calls, emails, and tweets on North American large caps. David, what a day to do it. Our number toll free, 1-855-326-6266. Our email address, marketcall@bnnbloomberg.ca. How are you feeling about these markets? It's day one for Canadian investors. Our friends south of the border had an opportunity to experience that huge sell-off yesterday. What are your thoughts?
So I think you have to break this into two pieces. If you look at the way the market has been behaving since the lows in December, you've seen a lot of repair. Things that I look at, what is it that led over the last 6 months? Well, it was the leadership that we had in 2016 and 17. It was technology, it was consumer, it was some parts of industrials like the defense stocks. So what you always want to see is if you think that you remain in a long-term bull market, you want to see the existing leadership reestablishing itself. And certainly we did that into making new all-time highs. We stayed above all-time highs for about 6 weeks into earnings. Lots of concern around earnings. Earnings came in a little better than expected. And in the absence,
in all fairness, a lot of those estimates were revised lower.
Absolutely, yeah. But actually the revision trends for second quarter were no worse than they have been over the last 5 years. So that's not a thing. It happens in second quarter. The beats were about 5% in general, favorable. In the absence of share buybacks, market behaving quite well. Now, that's the first piece.
Okay.
Right? The second piece is we're living in a quite a news-driven market.
We are, yeah.
Where in this bull market, we have an incredibly jittery group of investors. So sentiment has remained very muted, and positioning actually was very, very defensive coming into this sell-off. So look, the advent over the last 5 years of systematic quantitative funds has become important. When there's a news-driven event, if you've got jittery long-only investors, the systematic funds, when they come in to sell and they hit their trigger points, it has a big impact. And that's what you saw yesterday.
It certainly seems, David, that you have to be nimble in this market. A lot of your colleagues that I speak to, they're either sitting on the sidelines, they've got their positions from years ago, they're sitting on the sidelines with a huge chunk of cash on the side there, or, and we're not even talking about your gold bugs here, but just regular folks that don't normally do a gold trade are now actually starting to build a position there. I'm not talking about your 5%, I'm talking 10% plus. And if we can throw up gold, we saw the dollar. Normally, it's a safe haven play. You see the U.S. dollar drive higher. But yesterday, we saw some bizarre action. Thanks, guys. We're going to have gold coming up any second now. We had some bizarre action take place yesterday where the U.S. dollar, the greenback, actually took a hit. And we saw gold jump up, David, about 25 bucks today, up another 5 bucks, 1481. David, we're closing in on $1,500 now. Look, 1350 was seen as the key resistance.
The gold trade has been setting up for months. And I'm not a gold bug. I'm all about finding key structural themes in the market. The gold's put in a low in 2015. They put in a higher low in 16. They put a higher low in last year in 18.
What does it speak to?
Well, look.
There's a group of investors that are significantly spooked, for lack of a better word, by what happened yesterday.
Gold is not just driven by U.S. investors, right? You have currencies moving around, and you have concern around negative interest rates, and they're looking for places to put their money. And if there's no cost of carry in most of the world, or a lot of the world, then you're not forsaking a coupon from a bond to own gold. So there's reasons why lots of global investors who are concerned about the weakness of their currency are buying gold. I don't think that the reason they're buying gold is they think there's a crisis. It's because they're looking for some place to put capital. Now, I'm going to make the same case for equities.
Okay,
look, we get 5% corrections all the time in the market. They're happening faster right now because I mentioned these systematic funds get forced to become sellers.
Right.
In the absence of bullish investors, it has an impact. The longer run picture is equities continue to be really, really productive, and they continue to be really attractive in a world where interest rates are almost zero. And the difference between what you get on a fixed income piece of paper in the US at 2% or 1.75 today versus 6.5% earnings yield in the average company is a really attractive buy. But stocks and gold, both attractive.
Okay, what I'm hearing from you is, you got folks in two different camps. You got folks in one camp who are like, I'm going to wait for more of a sell-off here before I even contemplate getting back into the markets. And then you got the other group, I think you're part of it, which is maybe buy the dip. We're coming back with David Burrows. We're just getting started. He's the president and chief investment strategist of Barometer Capital Management. We're on North American large caps today. How fitting. Call us 1-855-326-6266. That number again, if you're listening to us on radio, 1-855-326-6266.